Hey everybody, welcome to Mortgage Today for Friday, October 20th, 2023, and oh, what a day it was. UMBS opened up 23 basis points better on the morning. S&P futures were down 14.75 points on the open. Equities fell and treasuries rose, and oil topped $90 a barrel on concern the war between Israel and Hamas may widen to a regional conflict. Investors were rattled by reports of more clashes in the Middle East, with the Pentagon saying it's seeing increase in drone attacks in Iraq and Syria. An American destroyer also shot down cruise missiles and drones launched from the Yemeni-based Houthi militants toward Israel. Traders were also parsing the latest batch of third quarter corporate results. Jerome Powell's speech yesterday was interpreted as hawkish despite some sentences that could be considered dovish. We also got comments from the Fed's Bostic, where he said, "I don't think the Fed will cut rates before the middle of next year." Fed Harker repeated that now is the time to hold rates steady. He thinks inflation economy is easing faster than thought. Unfortunately, the bond market sentiment is so awful right now that even neutral data or comments is considered bearish. This is often typical at the end of bear markets. The market seemed to seize the comment that monetary policy is not too tight right now. The last month has seen an extraordinarily heavy amount of U.S. issuance. There's been $580 billion in the last 30 days, which works out to an annualized pace of $6.9 trillion, or about 3.8 times the 2022 issuance. The last month's issuance probably won't be repeated, although it pushed 10-year yields to multi-decade highs. We also got the Atlanta Fed GDP Now estimate for quarter 3 GDP is still above 5%. To me, that doesn't quite square with any of the other data we are seeing. Zillow is predicting a 3.3% full-year appreciation rate in 2023, revised lower from 4.3%. They predict 2.1% next year. Rates fell noticeably on 3 of the last 4 Fridays, not counting today. In all 3 cases, the subsequent Monday saw a sharp correction back toward higher levels. Now today, bonds rallied fairly well after a week of steady selling. Is it just a token Friday correction or something that actually carries some weight moving forward? There are ways to make cases for both outcomes. We can see the tone shift from the Fed, perhaps some value buying at the 5% level on the 10-year Treasury, but it would be impossible to get very excited about the Friday gains that occur the day after hitting the highest yields in more than a decade. In any event, all crystal ballers should be falling back to the old familiar data-dependent mantra. The only catch is that the upcoming week of data doesn't really cut it in terms of big picture significance. MBS closed the day up 19 basis points, closing at 96.69. So at 96.69, it's right on that 25-day moving average is falling, with a 50-day moving average right above it. So we'll have to see if the Monday gives it all back. Next week, we got some data coming on Tuesday. We have the services, S&P services PMI, which will go into inflation expectations. We have a couple note auctions on Wednesday. Thursday, we get jobless claims, which has been moving the market quite a bit lately, as well as durable goods and core capex. We also get the third quarter GDP number, which will indicate inflation, and then on Friday, core PCE inflation, which that will be a market mover. So get ready for next week by relaxing a little bit this weekend and check out some of our common sources and influence, particularly our sponsor at That Makes Sense. That had a couple of great articles about building $100 million sales teams this week.